With just over 12 minutes left till the closing bell on Wall Street, we're looking at how to navigate the big picture with the Yahoo Finance playbook. The broader market indices as of late have been largely at the mercy of big tech. Looking at you, NVIDIA, we're taking a look at where the market may be broadening and where investors can therefore find opportunities. Joining us now, Katy Kaminski, AlphaSimplex Chief Research Strategist and Portfolio Manager, and Johan Grahn, Allianz Investment Management Vice President and Head of ETFs. Excuse me. Guys, thanks so much for being here. It's great to have you both in the studio with us. Yep. So, Katy, I want to start with you because I think it is a confusing time for some investors, right? Because we've had this monster tech rally. We've had a lot of talk about broadening. But now I think people are kind of confused where they should go, whether they stick with tech, whether they go to those broadening areas.
This is a really good question because I think it's just been such a strong move in the markets, particularly in tech, and it just keeps going. And I think today we're seeing some of that again. So it is hard to go against that trend when the trend just continues to keep being so strong, despite what we're seeing in the other markets out there, like in fixed income.
And Johan, I'll bring you in here too, on that same theme. I mean, clearly momentum has been a big focus for this market, right?
Yeah, it has. I mean, but it's all been gravitating from or pulling from the tech sector, right? But it's been broadening out, like you said, and I think that's the key story. Like, it used to be, call it the Mag 7, lifting all boats, but now it's really all the boats lifting the Mag 7s, if you will. You have a very broad-based rally, call it the last 4 or 5 months. The tech sector is up maybe 30%, but everything else is also up. And that's what you tend to forget sometimes. But this is really broad. A lot of stocks are well beyond their 200-day moving average. So what we're seeing now is very different. It used to be tech, driven by what the expectation is in terms of what the Fed will do with rates or not. Now it's much different. It's much broader now.
And so if that's the case, do you stick with tech, as the picture changes a little bit, or do you go even more broad and just buy the market, Katy? How should people be thinking about it?
Well, I mean, I agree with Johan here, is that you've actually seen that it's also international. So it really has been spreading to a very nice, very long equity trend that has worked very well. And I think that's what makes people a little nervous as well. You're starting to see valuations pretty high. You're starting to wonder, at what point does momentum slow down? And I think if you look at some of the names and the crowding in names, it's definitely something that people are worried about to some degree. What slows down that train?
So what does slow it down, and when does it slow down? Tell us exactly.
I mean, honestly, like 2 months ago, I was thinking it would slow down. I thought it would slow down in February. And here I am in March. This week has been a big mover. We saw a little bit of a pullback, but now we're seeing everything back to everything's business as usual. Things are going well in the equity markets. And I think that continues to surprise me. We're momentum traders, so we're going to continue following that momentum until we see something that kind of changes the narrative.
And Johan, so there's viewers right now, they're listening, they're wondering what do they do with their money. One strategy you talk about are these kind of risk mitigating ETFs. Explain what those are, Johan, and maybe some examples as well.
Yeah, I mean, it's kind of cool because you have a market now that feels a little toppy, a little peaky. There's a little bit of nervousness coming into it, at least at this table. But you also have a lot of investors out there still bullish. There's still this pressure coming up from underneath. The irony is that you have a ton of cash on the sidelines. So people are clearly nervous with how they're voting with their dollars. No question. So the buffer ETFs that you're referring to, structured ETF, defined outcome ETFs, they provide a structure inside of an ETF that gives you upside exposure. So if you buy them today, you can still make money on the upside up to a certain level, like a cap, but you're buffered underneath on the downside. So if the market is down by, you have options here, either 10% or 20%, you don't lose any money over a defined outcome period. So over 6 months or 12 months, for example. So you can partake in the market, but you don't have to go all the way into the market.
Well, and you refer to a lot of cash on the sidelines. I would submit that at least, yes, people might be nervous in keeping money there, but they're also making money, gaining interest in money market funds, for example, for the first time in a long time. So how does something like a money market fund compare to something like you're talking about?
Yeah, sure. So if you think about it this way, if you're in a money market fund, you're getting income that's getting taxed and you still have inflation. So there's not a ton of juice left, even if you get 5% from it. The buffer ETFs that I'm talking about, if you have a 10% buffer, in other words, the market can come down by 10% and you're still made whole, you have an upside cap, the last fund that we had now, about 17%. So you can make 17%, and the opportunity cost is the difference between the 17 and the 5 if the markets continue. Being in a money market when the market's rallying, you have to make a decision to give up that opportunity cost.
How do these kind of buffered ETFs you're talking about, how do they sort of fit into the overall investors' portfolios?
Well, it's a very versatile product, and when you don't have time for my whole answer, so I'll keep it short.
Give us the cliff notes, Johan.
Cliff note. If you're looking to retire, or if you have retired, and you're starting to think about reallocating your portfolio to be a little bit more conservative, typically you move from equities into bonds or cash, high level speaking. You don't have to. You can still have access to the equity risk premia. You move money from pure equities to buffered equities. You take some risk off the table, but you don't kiss all your equity positions goodbye.
And Katy, to get back to the momentum idea for a moment here, are there pockets where you are seeing a special momentum right now? And what are signs that that is breaking?
This is a good question. I mean, I think we've been so focused on equities that there has actually been some interesting trends out there that we've been watching, particularly in the commodity sector. You've seen a lot of divergence there. You've seen energies up quite a bit today. I don't know if you saw there was some pretty sizable moves, but we've also seen negative positions and short views in the agricultural sector and very disparate, interesting opportunity sets that are going to lead to very different possibilities for thinking about inflation. So we've seen divergence across commodities. We're following things like cocoa. We're following things like corn and also soybeans. Pretty large trends there, which may start telling us where inflation could be going next. If we start seeing that revert, which we have seen a little bit this month, there's some chance that inflation higher could provide some interesting opportunities in the commodity sector. But also short bond positioning is also interesting right now. This idea that cuts are possibly coming later this year rather than sooner. So
interesting stuff.
Interesting stuff.
Yeah. Cocoa, I know, has been a rocket ship.
27% in February.
Yeah, I saw some charts compare. I think our Jared Blicker has a chart comparing it to NVIDIA, so that tells you something right there.